following program is a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com or search for Options Insider Radio in iTunes. It's time for Volatility Views, the premier radio program for volatility traders. Each week, we'll dive into the world of volatility, how to manage it, profitable strategies, and how to avoid the pitfalls of trading volatility. If it involves volatility, you'll find it on Volatility Views. And now, the Volatility Exchange is proud to present your hosts, Mark Longo and Don Schlesinger.
Welcome back to Volatility Views, and I hope everyone out there is having a great trading week, or I should say a start to the trading week, because we're recording on a different day than usual. We're recording on Monday rather than a Friday, but there is still a lot to dive into and parse from the week previous, as well as what's to come in the world of volatility. My name is Mark Longo from theoptionsinsider.com, as well as most of the programs here on the old Options Insider Radio Network. And we are joined today by quite a cast of characters, starting off with my usual boon companion, good old Don Schlesinger from the Volatility Exchange. Don, welcome back to the show, sir.
Thank you, Mark. It's actually been quite a while. We skipped a week when Mark Sebastian and Bob Krause did the show from the Traders Expo in Las Vegas. And then, as listeners probably realized, we took a week off for the Thanksgiving break. So I feel a little like a fish out of water. It's been more than 3 weeks, but here we are again.
Yeah, it has been a while since you and I have done the show proper, as it were, since we did that crazy offshoot out in Vegas where we allowed Mark and Bob to have the reins of the show. Now we have the show back in HQ, and it feels good to be home again. And of course, we are, speaking of Mr. Seabass, we are also joined by Mark Sebastian from OptionPit.com. Mr. Seabass, welcome back from Vegas, sir.
Oh, thank you, Mark. It was a pleasure, and it's nice to be back to the Sold to You show, because I was missing it.
And well done on your Vegas segments, by the way. You are quite the able stand-in host. So
well, it's I consider myself your Scottie Pippen in many ways, to your Michael Jordan. So I may be able to get the '95 Bulls to the championship game, but in the end, there's going to be some sort of poor call by a referee that's never going to let me get to the championship without you.
Well, you do set a mean pick, and you can lead into a nice layup, so you do have some utility for me.
The good news is when I get upset, I don't sit the game out because I'm not taking the final shot.
You just pout on the sidelines, but you still stay on the show. You don't turn your mic off.
Exactly.
All right. And last but certainly not least, we have a newcomer to the show. We'd like to welcome him to the program. He is Larry McMillan. You probably know him from many of his various endeavors throughout the options business. Larry has been around almost since the earliest days of options. And it's not to call you old Larry, it's to say you are indeed experienced and experienced in the field of options. Of course, many of our listeners probably know you from your seminal tome, McMillan on Options, both editions, but you have quite a few other undertakings going on over at Options Strategist. You have quite a lot of activity in the volatility realm these days, which is one of the key reasons why we wanted to have you on the show today. Of course, you have your Options for Volatile Markets books, both the first and second edition, as well as a number of webinars you have running over there on Options Strategist right now, including Understanding VIX Options, you have Trading VIX Options, you have Strategies for a High Volatility Environment. So you are definitely knee-deep in the land of volatility these days. And Larry, it is a pleasure to have you on the program, sir, today.
Thanks a lot, Mark. I actually do go all the way back to the beginning of listed options. Actually, even probably did trade options a little bit before that. But we don't need to go into exactly how many years ago.
I didn't want to date you, so I didn't specifically say that you predated the options business. I kind of just let it out.
Well, I mean, they listed options in what, 1961 or something along those lines.
73 was
73 was the calls, and 77
I know.
I think it was 1922 was the first listed call option there.
Well, Larry may have been there when they listed call options, but Don was around when at the Buttonwood Exchange, believe it or not. So that's what he's famous for. He actually made the second trade at the Buttonwood Exchange.
All right. And with that obscure reference, we will dive right into our volatility review.
It's time for the Volatility Review.
And welcome to the Volatility Review. This is, of course, the portion of the show where we dive into the volatility action and analyze and parse it for the previous week. And it was indeed quite the active week. I know we've talked quite a few times on this program recently about the VIX and general volatility, of course, and a lot of people leaning to the downside for quite a long time since going back to the original debt debate a few months ago. A lot of people coming in leaning very heavily to the VIX downside. Of course, that trade has not exactly panned out until recently. We finally saw the VIX breaking through that historical 30 level and trading into the high 20s. As we record this right now, the VIX cash is hovering at 27 even, down about half a handle right now, and the broad markets are all up about 1.5% to 2%. So another up day on the street, another slightly down day on the old VIX. Is that what you've been seeing as well, Mr. Sebastian? I know you're probably happy. You've been one of those people I know who's been leaning to the downside in VIX for quite a while, and it's finally starting to move your way, sir.
Yeah, it's interesting. On Friday, the futures themselves moved into a full contango, and I was just having a debate, and this will be an interesting question. The VIX level has not kept up with the market, so the market has actually rallied harder in relative terms than the VIX has kind of fallen. So that correlation is broken a little bit, and the question I was asking myself is: are people buying insurance, or are they buying the gamma? And right now, I actually think they may be buying the gamma, because even in an up market, our realized volatility levels have been really high. Vol can go up and the market rally, and that's kind of what we're seeing right now. But yes, I've been short a lot. I got really short when we got down to about 1160, short vol, that is, not short the S&Ps. That would have been disastrous. And I've been riding them up, and looking at kind of vol in the market, kind of general levels, I like the fact that we're trading 1265, and the VIX is at a lower point than the last time we were up here. So it's kind of pointing toward what I think is kind of some bullish steps. I think we may have broken that range. We were in kind of that 30 to 35 range in VIX. I like to think VIX has kind of two means. It reverts to its long-term mean, and it also reverts to kind of near-term mean. And so I think that we've broken out of that kind of near-term mean between 30 and 35 and are probably stuck between 25 and 30 for the near term until the market can break itself out of it. So, yes, it's been a nice week for me the last couple of days. Let's just put it that way.
Nice when a plan finally comes together.
On a dog's hindquarters every once in a while. Let's just put it that way.
And Larry, is that your consensus as well? What are you guys teaching over there at Option Strategist right now? What is your take on these current VIX levels? Are you feeling that we're going to be hovering here for the foreseeable future? You think we're back off to the races again to the upside? You think we'll be gently drifting to the downside? What is the current thought process over there at Option Strategist?
Right. Well, there's a definite seasonality drain in volatility from October through the end of the year. So we set up back spreads in our managed accounts. In addition to the educational stuff we do, we also publish a lot of research, including newsletters, and we make specific recommendations in VIX. But we also manage accounts as well. And we set up back spreads last month, really, so that we're long extra puts, we're short in the money puts. So if for some reason Europe should explode, and the market collapses and VIX goes back higher again, we could still make a credit off these back spreads, as a fixed limited profit, but still a credit. Meanwhile, if it goes down, VIX goes down as we expect, then we're long extra puts, and so that should work out there too. We do worst if VIX just hangs around 30. So I'm really not looking for it to just hang around 30 through the end of the year. I'm looking. I agree with Mark Sebastian. I definitely think it's heading lower. The only problem is that every time we've gotten down here in the last 2 months, the market's got slapped real hard again. And this 200-day moving average that SPX is bumping up against here is definitely on the the radar of a lot of big institutional accounts. I read a whole thing this weekend by these guys who are pretty much saying that it's a great shorting opportunity, shorting the market to short it right at the 200-day moving average, and you cover if you go like 1.5% through it or something like that. So that's why the market's, I think, having a little trouble right here. But even so, the VIX could still decline. It doesn't necessarily mean that just because the market can't get through the 200-day moving average, that VIX doesn't, the VIX has to go back up. I'm generally in agreement looking for a decline in VIX through the end of, or at least through Christmas, let's say.
Seems like everyone we talk to pretty much has that same general consensus these days. Yeah, exactly. That's always a little scary. It's not quite as ubiquitous as it was going into the initial debt ceiling deadline when everyone and their mother was leaning super short to the downside in VIX because they thought it was going to come off overnight after that deadline passed. And of course, we saw the S&P downgrade and everything else that followed that sent VIX off to the high stratosphere. But we are seeing everyone saying something similar to what you're saying, where everyone leaning the way the futures are short in the long term, but in the near term, no one knows what the heck is going on. So they're really kind of backing off.
We're seeing this kind of consolidation, and that's one of the reasons why I'm trying to figure out whether we're consolidating, or if volatility is consolidating, or if volatility has just entered a new kind of level. The Wednesday before Thanksgiving, I got up on Bloomberg and said I was bullish, and the girl basically laughed at me. And the reason why was, as the market was selling off, VIX was not rallying. We're kind of seeing that same thing down here. It's just, I don't know what those numbers are going to end up really looking for. One thing I would point out, and I've actually found this to be a pretty good leading indicator, is even better than VIX itself has been the volatility of the VIX options and bond volatility as well. Both are being sold today. I don't know, Larry, have you looked at that at all? Or Don, this has just kind of been anecdotally. I found that the volatility of the options on VIX have been an excellent leading indicator.
Yeah, we follow quite a bit. There's a huge skew in those options, as you know, if you look at them. I mean, what I mean is that the near-term options, the near-term futures are way more expensive. Of course, the near-term futures are way more volatile than the longer-term ones. But also the out-of-the-money calls in VIX are way more expensive. They have a higher implied vol than the at-the-money calls or in the money. So, but adjusted for all that, you're right. I mean, it has come in, and I don't. I'm still the jury. I think the jury's still a little out on that as a market indicator. But what you mentioned last week about the market going down and VIX not going up that much, that definitely I thought was a good clue too. And we were getting long, but I actually thought that after Thanksgiving the market would open down at least a little bit on that Monday and have a chance to really get long. And I was wrong about that. It just gapped straight up and kept on going. But yeah, so it wasn't as long as I wanted to be.
I think that massive move to the upside caught a lot of people off guard. At least
it wasn't short.
Yeah. Of course, we do discuss the general volatility on this program, but we also dive deep into specific areas of volatility, including the land of Euro Vol and the good old Euro Vol contracts over there. So, Don, let our listeners know what you've been seeing, what you've been watching over there in the land of Eurovol for the past little over a week now since our last update.
Well, it's actually several weeks since the last time I was on the show, and I made a note of that current level because I remember discussing 16.56 and commenting on how extraordinarily high that was in the general scheme of things for the euro. Of course, there was an awful lot going on in Europe, but you know that at that particular time, we indicated that those levels probably would not be sustainable and were more likely to drop over the coming weeks. So we now have 1 week to go in the front month one vol, realized volatility for December, and we're now sitting at 12.54. So we did have the considerable drop off that we had thought would occur, and with 5 days to go, still including today, basically the Volatility Institute forecast for the expiration from Robert Engel's group is right in line at about 12.42. So we've consolidated somewhat. I'd also mention that in terms of this current contract, it hasn't disappointed for the potential of substantial movement for anybody buying or selling and trading it. We had a high of 1803, and the current settlement of 1254 happens to be the contract low. So that represents a move of slightly over 30%, which is in keeping with all of the previous front month contracts as well.
Don, forgive me for asking, because I'm not exactly familiar with the index you're quoting there. Which one is that?
I'm quoting our realized volatility futures. In other words, the volatility exchange listed vol contracts on the CME. And so this is the front month, the one vol, as we call it, for the euro. And then concurrently, there is a 3 vol, so a quarterly, that's also going to be expiring simultaneously. And that December contract closed at 1332 and has an accumulated volatility for the entire period of just about the same, 1334.
All right, thanks.
All right, Don, thank you for that. And with that, we're going to close out the volatility review segment and dive right into our volatility viewpoint segment.
Now it's time to discuss volatility and volatility trading strategies on Volatility Viewpoint.
And welcome to the Volatility Viewpoint. This is, of course, the portion of the show where Don and I grab some poor, unfortunate soul, usually a luminary from the options market, and force them to answer our questions. And today's unfortunate soul is indeed a luminary of the options market. Of course, we had him on. Of course, you heard him in the intro segment. He is Larry McMillan. He is of numerous accolades and fame within the option space. In fact, Larry, I think the last time you and I bumped into each other was down at the OIC in Savannah back in May, where you were receiving the Sullivan Award from the Options Industry Council, which is, of course, their equivalent of the Lifetime Achievement Award. So yet another award to add to your award-heavy shelf, I'm sure, over there at the McMillan HQ.
All right, thanks. Yeah, I don't know how award heavy it is, but I was certainly pleased to receive that award.
And of course, it is well deserved because, like for many guys like myself who came into the business in the mid '90s or so on the trading floor, there was kind of a you had two Bibles down there. You had McMillan and then you had Natenberg. Those are the two books everyone had in their back pocket when you first started off on the floor. Those are the books they handed you, and there was always a bit of, I guess you can call it a dogmatic schism between those who leaned in the Natenberg camp and those who leaned in the McMillan camp. There are a few Hull guys floating around as well down there too, but it was always interesting to see who leaned one way or the other and which books they had. A lot of people had both, so it was you were definitely a heavy presence down on the SIBO floor. So that Lifetime Achievement Award is definitely well earned, sir. I think we so congratulations yet again on that.
Thank you.
And of course, many of our listeners also will know you from the McMillan on Options and many of the other tomes you have there. And I think, like I said in the intro, I think a lot of our listeners will know you from those books and some of your earlier work, and will think of you very much in that general options education camp, when, quite frankly, if you look at what you've been doing for the last 4 or 5 years, it has a very strong volatility bent to it. Would you say that volatility and volatility education has definitely, taken the reins of your education a bit and shifted it in a new direction, where you're spending a lot of your time working with retail, actually explaining volatility as an asset class and the different ways to incorporate that into their trading? Is that the bulk of your time these days?
Well, yeah, definitely. I mean, as I said, we have a lot of different facets to the business, but yeah, everything is very volatility oriented. And, the introduction of listed volatility derivatives really has changed the landscape. I mean, prior to that, if you wanted to be long vol, you had to try to buy straddles or some obtuse thing like that. Whereas, here, you can actually trade the things directly, but there's still a lot of misconceptions, and there's a lot of people that don't seem to understand them, and so I would say it's not the simplest product in the world, potentially, especially since the VIX options don't, since they price off the futures, and most other people are not familiar with looking at options in that way.
How many times would you say you answer that question in a given week? Why aren't these options, why aren't they queuing off the VIX cash?
Yeah. I mean, we don't get that specific question too much anymore, except if I go to, like you said, like you go to the Traders Expo, or you go to the Money Show or something like that and give a talk there, then you get that question a lot. But I hope to think we've educated our own customers and our own mailing list pretty well. Maybe not. Who knows?
That's true. You probably have a very select subset.
We're 32 years into options or whatever it is, and we still people don't understand what a put is. So maybe I'm being too optimistic.
Now, if you had to ask me the two most frequent questions we receive still to this day at the Options Insider, it'd be number one would be, of course, I bought a call and the market rallied. Why did I lose money? And then number two would be, why I'm looking at the VIX. The VIX is X number. I have these VIX calls. Why aren't they in tune? Why? And you have to, of course, explain the futures to them. So that's probably up there, the number two or number three question still to this day. It's just
right along with, hey, it's Thursday. Why are my VIX options not in my account anymore?
Yeah, there's definitely a lot of logistical questions to overcome when people first are coming to the VIX. But speaking of that, just in general terms, you obviously, like we said in the intro, you've been dealing with retail education for quite a long time, almost since the advent of listed options themselves. How crazy is it to you that in this day and age, in 2011, going into 2012, that you are actually spending a lot of your time these days educating even incoming basic retail options traders on something as intricate as volatility? Would you have ever imagined that, 20 odd years ago, that this would be where the education would move, and where a lot of the questions and the ground field work would actually have to would be in volatility and volatility trading for retail?
Right. I don't know what 20 years ago, but I have felt for quite a while that we did need listed volatility derivatives. And now that we have them, there's always going to be an education gap that has to be filled on anything like this. I mean, I remember when they listed puts in 1976. At the time, we had 250 stocks with calls, and they listed puts on like 20 stocks. And I was working at Thompson McKinnon at the time. I was the retail options strategist, and my boss said, well, they're going to have puts on every stock. And we all went, really? And I'm like, wow, that's an amazing concept. Well, now, of course, you wouldn't consider having a listed, stock with listed options always has puts and calls. Hopefully someday we'll get to the point where they'll have puts, calls, and a volatility derivative on everything that has listed derivatives. So we're a ways from that yet.
Well, sure. we may help make that a reality one day, Larry, because into the future we foresee not only having our realized volatility futures contracts on a wide array of underlying assets, but it would then be the next generation to go into a concept that we call vol shares, which would trade priced with no multiplier, just like a share of stock, and would actually reflect on settlement the realized volatility of the underlying shares. So it may not be for tomorrow, but it's definitely something that we've actually written about, applied for patents, and actually have in the pipeline.
You know, Larry and Don, I think it'd be fun to have a show just with you, Don, Larry. Maybe we grab Alex Jacobson from Options Express and we can have an options reminiscence story where we can have a bunch of guys who have maybe a longer term perspective on the options business, and we could reminisce about some of those early days before there were puts and all of the other fun stuff. I'm sure the three of you could really tell some interesting tales about those days.
Well, I actually remember when I started at Morgan Stanley in the fall of '84, I was sitting right next to Steve Feinstein, who was the head options trader, and he had a very dear friend, a lady by the name of Irene, who was Larry's right-hand gal at Thompson McKinnon, and so we're going back almost 30 years, huh, Larry?
Oh, yeah, absolutely. I got in Steve a couple of years ago, but some high technical, like, wow. he's a rocket scientist in this business. I haven't seen Irene in a few years, though. Have you?
No, lost touch.
All right, and listeners, we had a spot of technical difficulties here, so we've switched Larry to the phone now, but other than that, we're happy to keep him on the show, and so we can keep having him answer your questions. And Larry, we were just discussing the comparative differences, if you will, between someone coming to you and saying, I would like to use, let's say, an upside VIX call as a hedge for my portfolio versus downside SPX put or even a downside SPX put spread. I know there's a lot of people who fall on one camp or the other in terms of what they prefer. What do you typically recommend over there at Option Strategist when someone comes to you looking for that type of, with that type of question?
Right. Well, basically, I view protection as a disaster protection. I'm not looking to hedge a 10% decline or something. And in that regard, I favor the VIX calls because VIX will explode much farther than the upside when you really need the protection. Say VIX is around 20 and you buy maybe the 30 calls as protection. If the market collapses, even if the market rallies for a while, but eventually collapses, VIX will go shooting through 30 and the protection will kick in for you. But if you buy SPX puts and the market rallies, then those puts get so far out of the money that they're no help on a market collapse, so you have to roll them up or spend more money for protection. So I'm definitely, in terms of ultimate protection, I think the VIX calls are better.
That's interesting. So you view of it more as I hate to use the cliche term, but a black swan type of protection where you're really looking to protect against the dramatic move as opposed to the more moderate fluctuations in the broad market.
Exactly.
And what do you do for near-term downside? You just let your portfolio run? Do you maybe do near-term put spreads, or what's the strategy there?
Yeah, what we do, I mean, the main strategy we're using in our managed accounts and things is we'll do a S&P or SPDR put ratio spread. So we'll buy one strike, sell the next strike, and then even sell another strike below that. So we've got a naked option down there somewhere. If the market declines slightly, the put spread actually makes money down to the third lower strike, which is the short put. And then we buy VIX calls as a hedge against that event happening, that it could drop to that third strike. So in that regard, and we set these up for credit, so you can make money if the market goes up, make money if the market declines a little bit. If the market really gets creamed, then you're relying on your VIX calls to hedge off the disaster of like August or something like that.
So you have more of a tiered approach then, where you take the S&P products and the put spreads and whatnot to the downside for the near term, whereas the catastrophic event, you tend to lean heavier towards VIX for that sort of approach. Interesting.
You know, it's really fun, Larry, to have these extra products floating around now because, you know, you mentioned the 1x2 or the ratio spread, and those were always tricky to handle as an options trader because you obviously wanted movement to make the money on the first spread, you know, before you got to the naked short option, and you were always rooting for movement, but then, whoa, not too much movement, not too fast, and go right over the hill. And so now you mentioned, you know, there's a fourth piece to it, and that's that VIX call. Nice to have those things lying around these days.
Absolutely. I can see you've been in this trade before.
Somehow I don't see you buying that VIX call, though, Don. Call me crazy.
Well, you know, it's different times, and you know what's the saying? Different horses for different courses. Some of those markets that I traded had single-digit realized volatility at the end of '94. We were looking at 7 and 8 on the S&P, and if you got 10 or 12 on implied, you were doing a great big deal. So we could afford to do spreads like that, and hopefully not worry that the market was going to do anything too crazy. But now crazy seems to be the norm, and you've got to adjust your approach sometimes.
Yeah.
Speaking of adjusting that approach, I know, Larry, before we wrap up, I did notice quickly on your website there that you are offering webinars now for gamma scalping and to instruct retail in the fine art, or some may call it the black art, of gamma scalping. And of course, that was the tool we used to use back on the floor to make our long premium positions, to at least survive our long premium positions, and on the off chance actually make some money with them. And it's often been one of the tools that's been missing from the retail trader's toolbox. So are you putting an increased emphasis on that going forward as a way to teach that missing implement to retail traders and allow them to trade more like an active professional options trader?
Yeah, well, I don't know if we have an increased emphasis on it, but the guy who's teaching that for us is Stan Freifeld. You guys might know him.
Yeah, I know Stan back from his OTA days, yes.
Mm-hmm. And so Stan is a great teacher, I think, and a very smart guy. So, you know, he came up with the idea that maybe we should try to, you know, discuss the topic, and it is very popular. A lot of people are definitely interested in it. I think once they realize how much work is involved, they may lose some interest.
That's true.
Not the easiest thing in the world to do.
Yeah, it requires definitely to be glued to your screens throughout the day, which is difficult for someone with a day job, as it were, to also be effectively scalping their gamma on a minute-by-minute or hour-by-hour basis. Right.
But, you know, in general, our products, our webinars have been successful, and Stan teaches our mentoring, and, you know, that's we've had a pretty good interest in that as well. But, you know, in that regard, I think our main impetus still is in our newsletters and the recommendations we make to retail through our newsletters. So that's probably our number one best-selling product, really.
Well, since you mentioned your newsletters and your products, let's dive into that a little bit for our listeners and let them know exactly what they can find over there at optionstrategist.com, the different services and the different products that you offer over there.
Well, we have 3 newsletters. The flagship newsletters in our 20th year publication, and that's the Option Strategist newsletter. It's got it comes out twice a month, and there's a weekly hotline update in between. But we cover the entire facet of option trading. We do some speculative buying, but we also concentrate very much on volatility trading, and including selling of high volatility premium, let's say puts on stocks that, you know, where we think that they're totally overpriced. Like, for example, Laura Larg in December, that sort of thing. And we also do a certain amount with volatility skewing, where we're looking for event-driven things, maybe earnings or maybe biotech situations or possibly even takeovers. So we set up volatility skew trades in those sorts of things. And then we do some actual VIX recommendations as well. But sort of cover the gamut there. We have a daily version of that newsletter too for total option junkies. And then we have another newsletter which is strictly what we call it daily volume alerts, and it looks for heavy option volume in a particular situation where we're just looking probably to just go long options, trying to follow along with smart money if we can identify where the smart money is actually working.
That elusive smart money.
Right.
You often find at the Options Insider, at least, that size money and the smart money are not always synonymous. And
no.
You see some interesting trades going up for quite a bit of size that are not exactly what we would call savvy, at least in the options spectrum.
Right. So we're looking more for just, straight out buyers of things, and, like you're saying, whoa, what's going on there? And then, the next day something happens and you go, oh, that's what was going on there.
All right, thank you for that, Larry. And that is going to do it for our Volatility Viewpoint segment. And now we're going to roll right into our Crystal Ball segment.
And now we take a look at the crystal ball.
All right, and welcome to the Crystal Ball segment. This is, of course, the portion of the show where we all start to prognosticate wildly, and we gaze deeply into our crystal balls to see if we can find what's going on in the land of volatility for the coming week. And starting off with you, Mr. Sebastian from OptionPit.com, what is lurking in your crystal ball in terms of volatility for the coming week, sir?
I think the market is going to continue to have trouble keeping up with the vol levels that it's posting. Last week we saw a real nice movement in the realized volatility world in the S&Ps. Today we're moving, but not as much as we kind of were last week. I think you're going to see near-term realized vol fall, and with that, I want to see the VIX break 25 by the end of the week, and I think we have a clear shot to test 1,300. That's kind of my view of the S&P 500. I'm seeing bond vol get smoked. I think gold. I think those of you that like gold, I would be a nice call seller here. I really like buy right opportunities in gold right now, and the S&P is just, I think we're going to hit some resistance here, but I like us to break and really threaten the new highs, especially I'd like to see some more selling in options, but this what the other thing kind of holding everything up is this European deal. Yeah, I mean, realized vol is going to fall, IV is going to fall, and I think we're heading for new highs. If I was really looking to sell volatility, though, I'd probably be looking at the precious metals. That's me.
I can think back to all of your numerous appearances on the network, Mark, and I think this is one of the first times I can remember you are espousing a bullish outlook in terms of the broad market, not just pure vol.
I know. Well, me and the mini metals have come together to.
The mini metals are all bullish as well. Well, whichever way they're leaning, I'm leaning with them. Those guys are geniuses over there.
They really are. So.
All right, Mark, thank you for that. And Larry, since we have you on the show today, we're going to pick your brain as well. I know you're quite a technical analyst over there at Option Strategist. So what's your outlook for the coming week or the next couple of weeks in terms of not just the broad market, but also where you think vol and VIX is heading? We talked a little bit about it in the intro segment, obviously, and the volatility review, but we can expound into much more detail here in terms of what you're looking at for the coming sessions.
Right. Well, I still have a bullish bias to the market. As I said, I'm concerned about this 200-day moving average, but if we can get through there and push higher, then I think we can continue on to the end of the year. I think if that happens, you really need to look at what's going on with VIX, because we had a very similar thing in 2007. The market rallied 1,000 Dow points from Thanksgiving to Christmas, and everybody was bullish. Everything looked wonderful. And as we got near Christmas, the VIX futures refused to drop with VIX. VIX was dropping, but the futures weren't. And they ended up with a large premium. The front month futures had like a $4.60 premium, which was is still one of the highest premiums we've ever seen, like in the front, with just a couple of weeks to go. And right after Christmas, the market collapsed. So, I could definitely see something like that happening again. But, short term for this week, I think the market's going to try to push higher. And I don't see volatility trending higher. I think it tries to go lower.
Yeah, it is hard to imagine it gapping up right now in the immediate short term, given all the inflation we've seen already on so many of these levels, and how many people are just lamenting the fact that VIX is just inflated overall, and that we're not moving anywhere near the 2.5% to 3% moves we need every day in order to justify these VIX levels. Yet somehow, miraculously, VIX is still staying in the high 20s to 30 level every day. So there's a lot more baked into that number than the math alone would indicate.
There's one kind of handy thing to keep your thoughts around, and that is if VIX is not doing what you expect it to be doing, or what your experience tells you it should be doing, you need to think of VIX as the cost of protection, really, because it is a measure of the cost of protection ultimately. And if it's if it's staying high when you don't think it is, then that means there's a big demand for protection. And I think there still is a relatively large demand for protection. On the other hand, a week ago, Thanksgiving week, when the market went down and VIX didn't go up, you could clearly see that people probably had the protection in place, and they might even been selling some of their protection off, which is what happened in March of 2009. If you'll recall, the market was dropping like a rock, and VIX really wasn't going up much because either everybody had the protection in place, or they were selling off what they already had. But either one translates into a sluggish VIX. So I think we're in that situation right now, and I don't know who still wants protection here, but I guess. Maybe they do. Don, I had a question for you, if you don't mind. In August, how high did your realized vol index get?
Well, the actual futures contracts probably have not seen a settlement in any contract that was very much higher than about the 18 that we actually recorded a little while ago. I may be misremembering. I'm trying to go back over all of the contracts. There might have been something actually above, but I'm looking at the front month, August. I'm not seeing anything. I tried to see the July, and that was in the 14s. And
this is on S&P we're talking about, or the euro?
No, you asked me about the euro. We have just a contract at the moment.
Oh, okay. Because the one of the big laments that people had was VIX went to 48, but the futures only went to 32. With the realized volatility contracts, it's kind of a hybrid during what we call the realized volatility period, because while there are some elements that are predictive and VIX-like, we're also logging close-to-close realized volatility every single day, and so the contracts ultimately settle to the realized volatility for the period of the underlying. And again, you may have had VIX at 48, but then you had to consider what would the actual realized volatility of the index have been during that particular period. And then if there were vol contracts trading on the S&P as the underlying, which of course we hope to have one day, you'd probably see that the trading would reflect both the actual market volatility that had been logged for the period, and then also a forward-looking hybrid where VIX or implied levels would come into play, but not as much as in the pure VIX index itself.
Speaking of euro vol levels, Don, what are you looking for here in your crystal ball for the week ahead in terms of euro vol? Of course, things haven't exactly settled down over there in the eurozone, so this is an interesting time to be gazing into the euro crystal ball.
Well, it is the expiration week for the front month, and so last night's settlement 1254. The partial volatility for the first 19 days is 1232. So there's still a little bit of a premium, as if traders are inferring from the data that will be a little bit over 13 for the coming week. And the forecast from the Volatility Institute using the Garch models actually is a little bit lower than the 1254, so a little bit at odds with what the actual values are. It's pretty safe to say that we should be looking for a close or a settlement price somewhere in the 1240 to 1275 range. On the 3-month contract, we've of course logged 59 days, and there we've got 13.34 in the books already. So with 59 days gone, we're unlikely to see too large of a movement there, and you'd probably look for a settlement fairly close to the values as of last night's close, which was 1332.
Of course, we all know what could happen in those final days of those contracts. We've said that several times, and then these things have gapped all over the place. So you never know what to expect in the land of vol contracts, I suppose, is the moral of the story. All right, and that is going to do it for our Crystal Ball segment. That's also going to do it for this episode of Volatility Views. I, of course, want to thank Larry McMillan for joining us on the show today, and encourage everyone, if you're looking for gamma scalping or volatility trading or any of those newsletters that Larry detailed, there's quite a bit for the options junkie, as he said over there. Then surf on over to optionstrategist.com. Of course, you can just search for Larry's name in Amazon. You can find all of his books are up there, and I recommend all of them as well. Many of them are in their second editions now, so you've updated the options for volatile markets, you've updated McMillan on options, so people can come in and get the newest updated versions of those. Have you embraced the Kindle and the ebook phenomenon as well there, Larry, or are you still mostly print?
Well, see, those two that you just mentioned are on Kindle. The options is a strategic investment, which is the larger book, and is in the 4th edition, actually soon to be the 5th edition. That is not currently on there, but I'm not the publisher, but I believe the publisher is going to put the 5th edition up there too.
Well, there you heard it from the man himself. He covers all mediums and all methods of information. If you want to find Larry, you can find him in print, you can find him on ebook, you can find him in webinars, you can find him in email newsletters, and of course online on a regular basis over at optionstrategist.com. Larry, it's been a pleasure having you on the show today. We'll have to bring you on again down the road, perhaps when the Skype gods look a little bit more favorably upon you.
Thank you, Larry.
And of course, Don, we also like to know what's going on, what's new, what's exciting over in the land of volex.us. So by all means, regale us with all the new developments since the last time we spoke about volex.us.
2 quick items on the website in the data section. If you scroll down to VolCones, you'll see that we have finally posted an article that I wrote for Expiring Monthly magazine. I believe it was published back in the August issue, and so that's now available to those who will come onto our website and look for the PDF of the Expiring Monthly article, going into a little bit more detail about VolCones. Second announcement, I wish I could say it's for tomorrow. It may very well be, but we're getting very, very close to going live on Bloomberg with a lot of our data, many of our charts, and a lot of the information that listeners can currently find on our website, but of course having it on a dissemination of information of the level of Bloomberg is something that we've looked forward to for a long time. So that is actually imminent, and hopefully perhaps even by our next show I'll be able to announce that we have gone live on Bloomberg with Volex information.
Well, great. I know a lot of our listeners have been looking forward to that day, Don, along with you. So they'll be happy to hear that shortly they should be able to access all of your information via their Bloomberg terminal, which will please quite a few of our listeners, I'm sure. And indeed, Expiring Monthly is a Mark Sebastian publication, one of his many ventures that he runs over there. And of course, I recommend all of our listeners to check out Expiring Monthly at expiringmonthly.com, as well as check out Mark's offerings over at optionpit.com. And that is going to do it for this episode of Volatility Views. I want to thank all of you out there in our listening audience for downloading and streaming and subscribing to this program and making it such a success. And we'll see you next week right here on Volatility Views.
Thank you for listening to Volatility Views. Join us next week as we keep our listeners on the cutting edge of finance and risk management with lively topics relating to volatility. Volatility Views is brought to you by the Volatility Exchange. If you'd like to learn more about VolContracts, please visit www.volx.us. If you'd like to submit a question for the hosts, then surf over to www.theoptionsinsider.com/forum and post your question in the Volatility Views forum. Questions can also be submitted via email at questions@theoptionsinsider.com or via Twitter at twitter.com/options and twitter.com/volx_info. Facebook users can submit their feedback via the Options Insider and Volatility Exchange Facebook pages. Voicemails are also welcome at 312-544-9356. Thanks again for listening, and we'll see you next time on Volatility Views. The views expressed on this program are not intended as investment advice and do not constitute an offer to sell or a solicitation of an offer to buy any securities or other financial instruments and may not be relied upon in connection with the purchase or sale of any security or other financial instrument. The opinions presented on this program represent those of the speakers and do not reflect the views of either the Options Insider Incorporated or the Volex Group Corporation. The preceding program was a presentation of the Options Insider Radio Network. For more programs, visit www.theoptionsinsider.com/radio or search for Options Insider Radio in iTunes.